Hey, what up, y'all? Welcome to the Runaway Slave Project. And on today's episode, we're going to be talking about how to actually pay yourself in a single member LLC. Now, before we get started, I must give you my disclaimer. I am not a tax professional, attorney, or CPA, and this is not an attempt to give out any kind of legal or financial advice. Do your own homework and seek professional consultation. Now, in this series, we've talked about everything from the differences between LLCs and DBAs. We've talked about how to actually form an LLC using websites like Legalzoom or Incfile. Now, today we're going to talk about, okay, what happens after you start making money? What do? You know, now your company's starting to boom and you don't know how to allocate this money properly in order for your business to stay sustainable. So this video is for you. Let's get to it. All right, now we got three definitions that we got to discuss first. And the first one is going to be gross. Now, your gross is basically everything that comes into your business before taxes, before you pay your overhead. That is considered your gross. So for this example, we're going to say that our monthly gross is going to be $18,000. The next definition is going to be expenses, and this one is pretty, self-explanatory. So expenses are going to be all the costs that are actually tied into your business. Everything that you have to pay for, your overhead, building costs, contractors, employees, all of that is going to be considered your expenses. Now, everything that you have left is going to be considered your net earnings. So like I said, net earnings is everything you have left after you pay your expenses. Now, mind you, we haven't touched on taxes yet, okay? So let's flip the board over on the other side, and then we'll get started with the rest of the video. All right, so this is the chart that I normally use when it comes to paying myself in my LLCs. What I like to always do is what I call the rule of thirds. Breaking my net earnings down into 3 equal parts, and then allocating those funds in the proper places. So if we're taking our example, which is $9,000 for our net earnings, what we got to do is we got to break that down into 3 parts. And the first section is going to be for taxes. That's the first thing you need to put money up for. A lot of people say pay yourself first. I don't agree with that. And the reason why is because it's 3 things that I'm afraid of in life. That's back taxes, back child support, and rats. I don't play with them 3 things. So for me, I'm going to get Uncle Sam out of the way first. So the first type of tax we're going to talk about is going to be self-employment taxes. And that's 15.3% of your net earnings, your total net earnings. So 15.3% goes straight to your self-employment taxes. Self-employment taxes is basically your Medicare as well as your Social Security. So next we're going to talk about federal taxes, which are dependent on your tax bracket, however much money you're making. And for our example, we're making about $108,000 a year. So our federal taxes are going to cost us 24% of our total net earnings. So you may have additional taxes that you may have to pay, such as state or local taxes. But for our example, we're going to leave those off. But as you can see right now, we're looking at paying almost 40% for taxes. We're looking at paying $39.3% for taxes. Now, you're probably looking at this number up here saying, well, we've already allocated 33% for our taxes, but this is 39%. Well, the way this works is you don't really always have to pay this 39.3%, because what we're going to do is we're going to add in tax deductions and credits and all kinds of stuff, and that will make our tax debt lessen a little bit, okay? And also, the more money we put in this second section will depend on how much money we actually pay for our taxes, okay? So the more money we put here in the second section, the less we have to pay for our taxes. Now, what is the second section? that's going to be business. That's what we're going to be putting back into our business. So I'll just put B-I-Z. All right, so for this second section, we're going to be putting money back into our business for certain things that are going to be tax deductible, which will lessen our tax debt in the end. So the first thing we want to talk about when it comes to business is growth and innovation. And I always say at least put up 20%, 20 to 25% comfortably for your growth and innovation. Let's just say 25% on the high end.
Hey guys, this is useless information that y'all never use. Just become a stripper or get your YouTube channel or find a rich person to marry. It's a lot of more stuff you can do. This is too much work for me personally. But yeah, is this recorded?
Anyway, setting aside 25% for growth and innovation is good, but you can actually increase this number if you'd like, because this is a key component when it comes to growing your business. You may have to acquire another company or tap into another industry in order to keep your business afloat, or in order to tap into a whole different side of the business. This is what companies like Facebook did in 2014 when they purchased Oculus. Now, Oculus is just a VR headset, video game console that the investors, they didn't see the vision at first. They were like, okay, what's the purpose of this? Well, now, 8 years later, we're talking about this metaverse that's about to take over the world, and now investors can see, okay, that's where you were going with it. So you may have to make different acquisitions. Amazon had to purchase Whole Foods. Tesla had to purchase Solar City. This happens all the time. The companies that don't prepare for growth and innovation are the companies that always fail. So I also set aside 25% for marketing and advertising, because this is probably just as equally important as growth and innovation, because your web presence, your social media presence, that's what's going to drive customers to your company. So you definitely want to make sure that you have enough money allocated towards this section, because, I mean, like for me, the way I got into business is through assisting people with their social media presence or starting a website. They didn't know nothing about websites, especially these old mom and pop shop restaurants and stuff. And once they get that online presence and can get people to tag them whenever they go to their restaurant, pay some influencers, that's when their business starts to boom. So marketing and advertising, key. The next one we're going to talk about is going to be equipment and supplies. Now, I'd say put 10% aside for your equipment and supplies, but this number can increase if you have that kind of business that just requires you to have, equipment or have different supplies on hand at all times. But if that's the case, then you should probably take money from those expenses. Remember I told you have your overhead? Well, you should probably use that in order to pay for your equipment and supplies. But if you got like some things that just pop up out the blue that you need on a regular basis, then this 10% is cool. The next one is going to be very important, and that's going to be education. Now, I'm not saying go back to college and get a degree or whatever. No, what I'm saying is those conferences and seminars, webinars and courses, all of those things can be important and can be key to the growth of your business. Okay, that's going to tie heavily into growth and innovation. So going to those seminars, you may learn something that's going to make your business more cost effective, and that is the way to do it. Always put money aside in order to grow not only your business but grow your mental. All right, the next one is going to be savings. Savings is very important. Now, I got two types of savings. The first savings is going to be what I call surface savings. All right, so this particular savings account is going to be for those unforeseen expenses that just pop up and you need to go quick, get some money. Hey, this takes care of this. The second savings account that I'm going to tell you guys about is going to be deep savings. All right, so the deep savings is going to be for those unforeseen events like, you know, the wildfires out in California, the hurricanes here in Texas and Louisiana, Florida. These events normally shut businesses down with the quickness. So the way to combat that is to always put some money back for your deep savings in order to sustain yourself and keep yourself afloat. Put back 10%. Now, during COVID, you know, during this time, I know the world is opening back up, but I would probably swap these two numbers out. I'd probably put 20% for my deep savings because we just never know what's going to happen. All right, everything is very volatile right now. All right, so we've taken care of our tax debt. We've put money back into our business. The very last thing we got to do is we got to pay ourselves $3,000. Now, you're probably looking at this example and you're saying, hold on. We made $9,000 profit, and I'm only gonna bring home $3,000. Yes and no, because the reason I say that is because all of these numbers fluctuate. You can play with these numbers, kind of figure things out for yourself. But let's just say you were to put less money back into your business. Let's say you was only to put 10% back to your business. You can put that rest of that 20% over here to your back into your pocket. Now the problem with that is, if you don't do these things, your business is going to suffer in the end. So it's always best to go at it thinking like, okay, business first, because all of these things are going to benefit you in the end. All right. So hope you guys found value in this video. If you did, of course, hit the like button, share, subscribe, comment, and hit the notification bell so you can be notified every time I release a new video. We're going to see y'all on the next go round. Peace.